Welcome to The Path to Exit, a podcast to help software and internet founders understand the process to raise capital or sell their business.
Hello and welcome, everyone. I'm Mike Lyon, founder and managing director at Vista Point Advisors. This show is dedicated to helping founders of software and internet businesses understand what it takes to raise capital and sell their business and how to do it well. My guest today is Loson Stockton. Loson's an associate at Vista Point Advisors and previously worked for D.A. Davidson and Software Equity Group in their software investment banking practices. Loson has literally looked at hundreds of software businesses and has analyzed their SaaS metrics. He has a keen sense for what makes a quality software business and how to use these metrics to optimally frame a business. In this episode, we'll discuss the key SaaS metrics, why they're important, and common mistakes founders make in tracking these metrics. Loson, thanks so much for joining us. I admit I was a little sheepish when I came to ask you to do this episode because I know how much time you've spent grinding through SaaS data, and I was a little bit afraid this was going to trigger you. So I appreciate you going back there for us.
Yeah, no problem at all. I'm excited to dive into it.
So for the founders out there, the reason why we're doing this podcast, and it may seem a little technical or maybe it doesn't even seem that interesting to you, but this is actually a really critical piece of data that we find most software companies get wrong. And it has massive implications for valuation, the way you run your process, the way diligence unfolds. So this is actually a really important topic that we spend a lot of time working on. And I would frame this as a pay me now or pay me later type of activity. If you do this right up front before you go to market your business, you're going to end up with a lot more interest, a lot less diligence, and more importantly, you'll have laid out all this data so that people can easily understand it. If you don't do that, you're really going to struggle in diligence, and you'll probably end up with a much lower valuation and less interest. So we're going to stay away from the math in this podcast and talk to you a little bit about the why. So Loson, maybe lay out for us what are some of the key SaaS metrics. We'll go in detail, but just talk to us about the key SaaS metrics and maybe in order of most important for valuation to least important to valuation.
Yeah, to start off, looking at your basic revenue streams and essentially how that base is growing and the scale of that. So you think about revenue of the business, ARR, bookings, that's going to be the first overall theme that businesses and investors will look at when evaluating a SaaS business. Retention is also really important. I think that's one that we've seen investors highlighting, and we can jump into how to look at the retention profile and how that becomes more of an art than a science. Gross margin is a big one in the time that we spent with businesses, specifically as we work with bootstrap founders. Gross margins are really important. Key metric for these SaaS businesses. It just shows the health and the profitability of the SaaS product. Next, to kind of measure overall profitability of business, the rule of 40. So that's just a simple, EBITDA margin plus your growth rate. And then looking at your EBITDA is just a great example of how a business is performing, and also that profitability aspect is big. But I think those are kind of high level, the metrics that are really important when looking at a SaaS business, and we can start diving into some specifics of each one.
Yeah, great summary. And again, this is in order of decreasing importance for valuation. 1 and 1A for valuation metrics are the growth rate of the recurring revenue and the retention rate. The growth rate sounds pretty simple, right? Calculating a growth rate's pretty basic. But I think what we want to get into here is there's a lot of different terminology you can use to talk about growth rates. And we see a lot of confusion around, what's the difference between revenue and bookings and ARR. And one of the things that rattles us a little bit when we talk to founders sometimes is they'll say that they're super buttoned up on all these metrics up front. And that literally sends a chill down our spine because there is a strong correlation to founders saying they're buttoned up on these metrics and them not being buttoned up. The R-squared is probably like 0.8. So we pay a lot of attention to that. And I think we really want to start with this concept of revenue, bookings, and AR. One of the first things we do when we get data that is supposed to be right is we plot the monthly revenue and look at that. What that should look like is a nice, smooth curve that slopes up as the business is growing. If you see data where it's really jagged month to month, that's either a sign that the business isn't really SaaS, or more likely these metrics aren't being recorded the right way. And the danger of that is if you give that to an investor or a buyer, particularly a PE firm, that's going to set an impression about the business that you want to avoid. So Loson, maybe help us understand the difference between revenue, bookings and ARR. We flip between these sometimes internally, pretty fluid, but they actually have distinct definitions and mean different things. But just want to make sure people have a foundational basis for that.
Yeah, so looking at these three different overarching themes of revenue, you have the basic revenue, and that's what you talk about when looking at your standard P&L that founders are giving us. And within this revenue base of basically just the P&L, there's two distinctions to make first off. Oftentimes we work with founders who will give us a P&L and we'll dive into the financials, and the first thing we do is just look at that basic graph, and it, to Mike's point, is all over the place. So one month it'll be huge, and next month you'll see a large decrease, and that tells us it's a cash-based P&L. We look at things on an accrual basis. So basically spreading out the revenue on typical GAAP standards is what we're looking at. So that's the most important aspect of basic P&L revenue, is looking at an accrual basis. That's the first of the three revenues. The second part is bookings, and this is really prevalent for businesses that are looking at SaaS contracts. So a booking, you could think about it as your sales rep has booked a contract that is quote unquote signed. The distinction to make there, though, is oftentimes you'll sign a contract for, call it, 3 years, and that revenue, albeit is booked, hasn't actually gone live yet. So there's this implementation period, call it 1, 2, 3 months, where again, this revenue is booked, but has not yet been recognized. We've seen a lot of our clients will position the business to get credit for this revenue, specifically looking at the implementation period, if there's any leakage. But I think that's important to look at, is basically bookings is at a high level any revenue that is contracted and or booked. And then lastly is ARR, and this is a really important one that you obviously hear get tossed around a lot in our business. And ARR, a great way to think about it, is kind of a spot rate of revenue. So at any point in time, you need to take your ARR, and it's going to be essentially your monthly recurring revenue times 12. And so the other distinction to make here is when looking at this ARR revenue, you need to ensure that this is contractually recurring revenue. So this can't be revenue of, one-time services, anything like that. You're not going to lump that into your ARR. So oftentimes you'll see your ARR is going to look different than perhaps your total revenue stream. That's kind of the last big three of the revenues, your ARR.
Yeah, great overview. And a couple of notes here. As founders, you generally don't care about your GAAP revenue. It's rare that we talk to a founder who's really focused on that. For obvious reasons, you're focused on the cash basis P&L, right? How much cash do you have in the bank? What are your expenses? But for buyers, and really to analyze the business, these metrics are really important to understand the growth. And one nuance I would mention to ARR, we'll commonly look at what we call CARR or CAR, and this is contractual ARR. This can be really beneficial in framing a business where there's a pretty long lead time between when you sign the contract and when you would actually implement the software, and then you could start recognizing the ARR. So CARR, you can show the effects of signing that contract a little earlier because we're focused on contractual ARR. And I would just point out, this is all really a framing game, right? So what you're trying to do is take the most aggressive definition possible for a lot of these metrics that you can also sell to buyers. And, the one thing I would not do, if you don't remember anything else from this podcast, if someone asked you for your revenue by customer by month, do not give them that. You want to make sure you clean up the data, you present the story around some of these metrics, and then trying to convince them of your definitions before you give them the raw data. But I think that was a really good overview. So as you think about growth rates, those are really easy to calculate, right? So we won't go into that. But it's really just making sure you're looking at the right metrics. Sometimes we'll present the growth off of a ARR growth rate. Sometimes we'll present it off GAAP revenue. Sometimes we'll present it off bookings. Some of it has to do with what's the best indicator for what the business is doing, and frankly, what's the best marketing definition. Moving on to the next set of metrics is retention. And the way I like to describe these retention metrics, it's kind of like EBITDA. Everyone thinks there's one definition for EBITDA. There's literally hundreds of definitions for EBITDA. It's not as defined of a term as you would think. Retention is a little bit like that. So we're going to walk you through the most common ways to measure retention, why they're important, what they tell you about the health of the business. But I would also say there's creativity here in how you can think about retention. The average business we work with, when they present us their retention numbers, we probably end up improving it maybe 4 to 5% through some what I would call true data cleanup issues. So this customer was acquired by this customer or changed their name, so it's still a customer. So that's more of a data cleanup issue. And also just thinking about the definition of retention a little bit differently, and maybe not using the entire revenue base to calculate the retention. Maybe we end up using 80% of the customers or some usage-based metrics to give us a sense for what our go-forward business will look like. So Lawson, frame up the differences between net, gross, and logo retention and why those matter and why they're important for a founder to measure before a process, and then obviously how that plays into valuation during a process.
Yeah, so I think these three are obviously called the big three of retention. And to Mike's point, a lot of nuances in the way you're looking at these. But starting off from your net revenue retention, this is going to be a revenue-based retention figure, so everything on a dollar basis. What this figure is essentially how your business is growing or shrinking without the addition of any new customers. So, for example, if your net retention is 110%, that means with your current customer base, with no new additions, you'd be growing your revenue base at roughly 10% all through upsells. So what this does is really just tell the story of how your existing customer base is behaving on a revenue basis. So it's taking into account all churn customers, all downsell, and all upsell. So again, if that number is above 100%, that's obviously a really good sign for us looking at a business because it just shows there's growth coming from the existing customer base. And then gross retention. This plays well off net retention because it's essentially how your existing customer base is behaving, but more so tracking just the negative aspects, right? So thinking about how the churn and the downsell is behaving, not taking into account any upsell or any new customers. So this number, for context, will never be above 100%. If you had 100% gross retention, this means you're never losing a customer and you're never downselling. But this figure really just shows any loss of revenue that you're seeing across your customer base is capturing this gross retention figure. And for context, if we look at a business and it's selling into more traditional enterprise or larger customers, you want to see this figure above that 90% threshold. That just tells a really good story that your customers are A, not churning, and B, they're not downselling. And lastly is logo retention. So this figure is completely based off actual customer count and nothing to do with the actual revenue. So this essentially just measures how many customers you had last year versus how many customers you have this year and what that percent is. So just a quick example is if you had 10 customers last year and you lost one this year and now you're sitting at 9, your logo retention is 90%. So this goes hand in hand to an extent with the gross retention. But those are the big three of retention. Happy to jump into maybe some specific nuances and or examples that we've seen and oftentimes how we're able to position these and increase these metrics.
Yeah, I think one point I would just mention about the net retention, there's a lot of different things going on with net retention. You can grow that because you're expanding within a customer base, right? The classic, you sell more seats. You can also grow that through pricing increases. On the pricing side, I'd say you don't get as much credit for higher net retention in 1 year. Let's say if you hadn't raised prices for 10 years, you raise prices 1 year, you have a really good net retention. That doesn't necessarily look as sustainable as if maybe you raised prices every year by 2%. Then you would certainly get credit for that increase in net retention because it looks sustainable. The gross retention, we believe it was just invented by private equity firms, right? Because if you think about it, it's really not giving you any credit for the upsells, but all the credit for the downsells. There's reasons why it makes sense to look at, but certainly PE firms focus on that a lot more than strategic buyers, and it has a lot to do with negotiating purchase price, we think. Logo retention is pretty basic and important, but obviously you get the fact that it treats each customer as the same size, which is not necessarily how you want to think about it. Other things I would just say in terms of, we mentioned the data cleanup aspect, and we probably spend, 40 or 50 hours on a deal just doing data cleanup. And it's painful, but it's really valuable. So it is definitely worth doing because you're going to get paid a higher price in the multiple. I think the other thing is just thinking about what data you apply these formulas to. So I'll give you a really common scenario. Software business is selling to some really high-quality customers. But since they're bootstrapped, they don't turn down some of these smaller customers that churn at a higher rate. And when you break the analysis and look at, for example, customers above a certain revenue threshold or a certain usage pattern, you see that the retention rates are drastically different. You might see 110% net retention for those bigger customers, and you might see some of the smaller ones at 70 or 80%. So a lot of what we do is split that out and look at those separately. And generally, our rule of thumb is if we can cover about 80% of revenue with our retention metric, and it makes sense based on the customers that you're serving, and you might not serve those smaller customers in the future, that is a way to show some better retention rates and really focus on the core business rather than just blindly applying those definitions to the whole revenue stream, which may not make as much sense. And frankly, you might make some changes about which customers you bring on going forward. Anything else you want to mention on the retention rates?
Because you mentioned price increase, which is obviously going to boost that net retention at a pretty big clip. But oftentimes the client or the business won't get as much credit because that upsell is coming strictly from the price increase. But with that being said, a business we're working with now saw this dynamic. So back in 2021, their net retention obviously had a huge spike due to a price increase by about 20%. So obviously our mind went to that and we thought, how can we best position that? And what was interesting here is when we looked at this price increase, we were able to tell this story of, hey, throughout this price increase, the net retention figure did increase by, call it 15 to 20%, albeit you may not get as much credit for that. But when we looked at how the churn interacted throughout that price increase, the logo and gross retention stayed pretty much consistent. We were still able to keep customers at the same exact clip that we were before. So it just tells a good story of how oftentimes the high-level retention metrics don't tell the full story. So that was when we were able to frame up a price increase to tell a nice story of stickiness behind the product.
Absolutely. And I think we spend 60-70% of our data cleanup efforts on retention. It's really important. It's complicated. And again, don't ever give anyone your revenue by customer file and let them run the retention for you, particularly if it's a buyer. They're going to come out with a different answer that isn't as flattering because it's a huge negotiating point when you get into benchmarking and how to value businesses. Gross margin, this is one I think we just rarely see companies calculate properly for SaaS businesses. And let's talk about why it's important. Probably more important than EBITDA margin. SaaS valuations are really high. Everyone's trying to be a SaaS business right now. And so if you only could get one data point to figure out if you thought a company was a SaaS business or not, it would be the gross margin. And it really speaks to scalability. Generally, what should be included in the cost of goods sold, the hosting cost, that one's pretty easy. Generally, people view that as a cost of goods sold. Customer support costs commonly are not included in that number, but should be included. And then what we would call break-fix R&D. So this is the amount of engineers that are dedicated to just keeping the platform up and running, not the R&D portion of it, not the new product development, but just keeping the platform running. And it's rare that folks put that in there. Sometimes we'll see people dump all kinds of other costs in cost of goods sold, things like selling costs or the salesman. And so what happens, that artificially depresses your gross profit. And if you tell someone you have a gross margin of 60%, they do not think this is a very good scalable software business. So there's a lot of signaling in that gross margin. The calculation's pretty simple, but a lot of people just don't really know what goes in the cost of goods sold, and there's some implications for that in signaling about how big the business can get. Anything else you want to add to that?
One key point here that we've seen, and we actually saw in a deal we worked on recently, was founders not quite understanding the importance of gross margin. And so, for example, this business that we were working with was an awesome SaaS platform, but they did have this services aspect to it, which obviously is going to be a much, much lower margin profile of the business. And this founder, we would talk about the business at a high level. He'd say, our gross margins are 65%. And anyone who hears that, their ears are going to raise and say, well, why is the gross margin so low for a software business? And really what the founder was doing was looping in all gross margin into one. So what we were kind of able to do and what we communicated to buyers was, hey, there's the overall gross margin of the business, that 65-ish range. But then if you look at the SaaS profile of the gross margin, that gross margin was actually up in the mid-80s range, which is a really strong gross margin. So I think just understanding that, framing up this gross margin, communicating the accurate gross margin, and again, if you have multiple business units, really communicating the true SaaS gross margin is going to be important as you talk to potential buyers or investors.
Next metric we talked about was the Rule of 40. And this is a really important metric to help people understand the differences and trade-offs between growth and margin. Some businesses are run for growth and they might have very low or negative EBITDA margins, and some businesses are built more for profitability. And it's a way to look at the trade-offs of those two and frankly compare those two types of businesses. Private equity firms in general look at this a lot. I think this metric has changed a little bit this year, and what I mean by that is in previous years, when looking at the Rule of 40, I think an optimal company, you wanted to see like 2/3 of that Rule of 40 come from growth, or maybe 3/4, and then the remainder of that metric come from the EBITDA margin. I think this year that's changed a little bit, where it's a little bit more balanced, where people like to see a little bit more profitability, just given what's going on with flight to quality. But Lawson, talk to us about Rule of 40 and where you see some of the trade-offs and how you think about that in terms of investors and buyers valuing a business.
Yeah, I think one point that's interesting to talk about here is looking at the rule of 40 based on businesses at different scale. So if you're looking at a SaaS business that's more in that maybe 1, 2, 3 million of ARR range, they're going to be a business where they're probably going to be prioritizing the growth more so than the profitability. And investors understand that. Investors can relate to that, thinking, hey, they're still in their hyper growth stage of the business. Whereas if you're looking at a SaaS business that's probably more in that 10 to 15 of ARR plus range, there's a little bit more of an expectation for the business to have achieved profitability within the business. Obviously, there's differing levels of that. But I think as the business continues to scale, the idea of getting more profitable becomes more prevalent to some investors.
Yeah, and I think rule of 40s can be very different. So if you take a company that has a rule of 40, so again, that's taking your revenue growth rate plus your EBITDA margin percentage and adding them together. Let's say that was a 50 and it was 35% revenue growth and the remainder EBITDA margin. That business would have a lot higher valuation than a company that had no growth and 45% EBITDA margin was just a cash flow generator. So you can't take this rule of 40 literally. You want to see a good balance of growth and some margin, or you better have extremely high growth if you have negative 20% EBITDA margins, right? But I think it's just a good way to normalize, and it's a good way for founders to think about if they have been taking cash flow out of the business, how can they normalize their performance against maybe a heavily VC-backed business who has a ton of growth but was also burning a lot of money. Last metric we'll talk about here, or second to last metric we'll talk about here, is EBITDA margin. And for a lot of growing SaaS businesses, EBITDA is not the most important. We talked about the gross margin, which really speaks to scalability. And for SaaS businesses, that's critical. Once you get below the gross profit line, a lot of these expenses are really focused on growth. So particularly if it's sales and marketing or it's R&D. So I'd say EBITDA is less important, but it's obviously better if you have more EBITDA than less. It will definitely improve your multiples. But maybe talk, Lawson, a little bit about adjusted EBITDA, founder expenses, other things to drive EBITDA up, and just why this metric is important. Maybe talk a little bit about the implications of being able to raise debt if you have EBITDA or don't have EBITDA.
Yeah, so to your first point, adjustments to the EBITDA is one that we're constantly seeing. And there's obviously the extreme kind of examples of this where a founder is perhaps financing something like a big jet through their business, but there's also just the standard stuff. And I think one that we're oftentimes seeing is basically this idea of founder compensation. If you look at a business that is pretty profitable and or is being ran as more of a lifestyle business, oftentimes founders will be paying themselves salaries that are up market compared to what a typical founder is being paid in a business. And what you're able to do here is normalize the EBITDA for that amount. So for simplicity, say the average, call it founder salary that you're going to be looking at, it's $100 a year, and the founder at a specific business is paying themselves $200. What we're able to do is add the difference of those two back to that EBITDA figure to give investors and buyers more of a sense of what the typical profitability going forward may look like for the business. So the whole idea is, again, to kind of paint that picture of what profitability at a steady state basis is going forward. So that's one key example that we're oftentimes seeing. Other things that we've seen is maybe they'll have a consultant come in or hire a contractor for a pretty large, significant sum of money that is really not necessary to the core business unit. So that's another example of, hey, we can add that back to the adjusted EBITDA. So that's kind of the idea of that adjustment. Looking at how to raise debt with that EBITDA figure, if you're having a cash flow positive business, the ability to raise debt and really the ability to finance a potential transaction through debt becomes much more attractive because it just gives peace of mind that the cash flow of this business will realistically be able to pay down the debt without any major concerns moving forward. So those are the 2 points that we see on that EBITDA that really becomes prevalent and important.
Yeah, and a couple of add-on comments on the founder compensation. Depending on your corporate structure, there may be tax reasons why you pay yourself maybe a bigger salary or you take a dividend. Really what we're trying to say here is just normalize that, right, for what you would pay a CEO of the business to manage it and take out some of those founder expenses and get credit for that. Obviously, during diligence, you have to walk through that, but definitely trying to normalize the EBITDA margin is a good point. And then I think on the leverage point, businesses that produce more cash flow, particularly if it's a private equity buyer or maybe even a strategic buyer, they will be able to pay more for your business if they can use some debt as part of the acquisition. And so trying to make sure you're showing high cash flow can actually help with the valuation of the business and make you just a little bit more attractive. As rates rise, this will become less of a factor, but as rates fall again, then it will be a big part of the financial engineering of what private equity firms do when they buy some of these SaaS businesses.
Mike, one other point too, I think that we actually had this conversation, I think it was yesterday with a client of ours, is in your experience, when clients or prospects are speaking to maybe investors or buyers by themselves, oftentimes they'll be very focused on highlighting their EBITDA profile. And I think an interesting conversation that we had is oftentimes buyers will kind of take that as maybe a hint to bid off that EBITDA figure compared to the revenue figure. And really, when you're looking at a SaaS multiple, you really want to be anchored off that SaaS revenue.
Absolutely. If you're a high-growth SaaS business and a buyer wants to focus on EBITDA, that's a pretty good sign they're probably a value buyer. It's not true in all cases. But in general, SaaS businesses are trading off revenue multiples, and there's a lot of focus on your growth rate and how you're going to grow the business. If someone gets overly focused on your EBITDA, that's a pretty good sign they're a value buyer. And as Lawson said, if you're highlighting that quite a bit, that can also be a signal to them that that's how you're thinking about it, or maybe you're not as sophisticated around valuation. So anyway, this comes up fairly frequently. If you're spending a lot of time with private equity firms or even strategic buyers, if they're really digging in on EBITDA, that's a bad sign for valuation. Just one other point I would mention. Occasionally, we'll run into businesses that have exceedingly high EBITDA margins. We sold a business a few years ago that had 90% EBITDA margins. That's super impressive and obviously a great business to own. But know that some buyers may perceive you haven't been investing much in the technology or the business. They may discount that EBITDA margin quite a bit because A, they think it's non-sustainable, and B, they think they're going to have to make a lot of investments to make the business a growing concern. So just think about that a little bit. While the diversification aspect of having a lot of EBITDA is great, once the EBITDA margins get past 30, 40%, there's kind of some diminishing returns in terms of valuation. And then when you start backing into implied revenue multiples, that's when things can get a little bit dicey in terms of monetizing that. Mm-hmm. I guess the last metric we wanted to touch on quickly is the CAC to LTV. So maybe Lawson, I know this is one we pay attention to, but it's certainly getting down the priority list. Can you just talk a little bit about how buyers think about that, what it's a measure of, and how founders should be aware of it?
Yeah, so that CAC to LTV ratio has been tossed around as quote-unquote the magic number. I think what this really is just a measure of your sales efficiency. So basically how you're able to bring on customers, the cost of acquisition per customer, and then also what the value of each customer that you're bringing on really brings to the business. So at a high level, that's that figure shows. I think as we've looked at these businesses and these figures, oftentimes, this number, the calculation behind it becomes nuanced to an extent. Mike, I'm sure you've seen this. You see a number of different ways it's calculated. The way that people approach it looks totally different. So at some point, this figure, albeit the idea behind it's important, you bringing on high-value customers at a low cost is very important, I think, to the business. Oftentimes, this number just gets skewed based on time period. Early on, businesses may not calculate this correctly. So I think it's one that is oftentimes just nuanced a little bit, but obviously measuring the health of your, call it, sales and marketing engine is very important. But I would say less important to anchor on one number in the way that perhaps you're calculating it internally. That just may not be how every outside party looks at it. So I think it's less important to anchor on the actual number, but more so just really be focused on the efficiency behind your sales and marketing engine.
The thing that always comes to mind for me is how you can't necessarily compare this metric across businesses. So let me give you some extremes. If you're Salesforce, and you're obviously spending lots of money on sales and marketing. I think for a while they were spending almost half of their revenue on sales and marketing. Your CAC to LTV measure is pretty strong because A, you're spending a lot of dollars, you're doing it at scale, you kind of know what your return is. If you're a founder-led business that's getting a lot of their revenues from referrals and you're not really spending a lot on sales and marketing, your calculated CAC to LTV can be sky high. Like you'd be out of the atmosphere in terms of comparing yourself to Salesforce. The problem is that's probably not a true reflection, and as you start scaling the sales and marketing, that metric is going to come down a lot, and there's going to be a lot of diminishing returns. And I think that's one of the reasons why, unless our clients are really spending at scale, that metric may look amazing, but to an outside party, they understand that you're not really spending at scale. It's certainly something to highlight, but know that there's probably some diminishing returns there.
Yeah, I would agree.
Well, I guess in terms of summary, we talked a lot about the key SaaS metrics, how they're going to impact valuation. We have a lot of content on our website that goes through the math. But I think the important thing to highlight is there's a lot of judgment that goes into how you calculate these metrics, particularly when you get to the retention numbers. And we just spend an inordinate amount of time trying to get that right. And again, trying to find that right blend or right mix between the marketing definition, so what shows good retention, but what we can also get buyers to kind of sign off on. And then I'll circle back to the thing I said in the middle of the podcast. If you only remember one thing from this discussion, do not give your raw revenue by customer file to a buyer. It should be your job to frame the retention, calculate the retention, get buy-off in how you think about retention for your business. And then once you've won that argument, later on in the detailed diligence phase, they can go through and verify the calculations. But if you just give them the raw file up front, you're setting yourself up for an analysis that they might do that's pretty punitive. And that can actually change some of the negotiation with the buyer, particularly if you're only dealing with one or two buyers. Anything else, Lawson, to add?
Oftentimes these metrics are kind of provided to you with just an equation, but there is a lot of work to be done in the background to kind of arrive at the most accurate portrayal of the business and also telling the right story. The data may say one thing. I think it's important to follow the actual story behind that data and really highlight what the strengths are and kind of identify the weaknesses. So all good points, and I think it really just comes down, as cliche as it is, it's more of an art than a science at some point to really highlight the healthiness of the business and the attractiveness.
Awesome. Thanks, Lawson. Appreciate the time.
Thanks. Appreciate it, Mike.
Vista Point Advisors is a founder-focused investment bank that advises software and internet founders through M&A and capital raise transactions. We are a fully unconflicted investment bank who only works for founders on the sell side, so you know that we're always representing your best interests. Securities offered through Vista Point Advisors, member FINRA, SIPC. This has been provided for informational purposes only. It is not intended to address all circumstances that might arise. Testimonials from past clients may not be representative of the experience of other clients, and there is no guarantee of future performance or success. Clients are not compensated for their comments. If you have any questions about the process of selling your business or raising capital, reach out to a member of our team, or check out the For Founders section of our site by visiting forfounders.guide.